Oh man, this is big. So Coinbase are applying to trade crypto futures in a push to start introducing derivative trading on their platform. So let's take a look at the article. So we can see Coinbase is planning to jump into cryptocurrency derivatives. The biggest US cryptocurrency exchange, Coinbase, filed an application with the National Futures Association on Wednesday to register a futures commission merchant. Okay, so they need to register as a futures commission merchant in order to be able to trade commissions. Now we know that the market leader are Binance in this space, and they had a futures trading volume of 17.1 billion in the last 24 hours alone. Now we spoke about this in yesterday's video about Coinbase. Coinbase really need to, and you can see they're making this big push to diversify their revenue outside of just transactional revenue. They know this is a concern and they know they need to address this ASAP, not just from a regulatory point of view, but they need to address this from a just a diversification point of view, full stop. Because if a platform was to come in and introduce a zero trading, a commission-free Robinhood style version of crypto Coinbase exchange, then Coinbase would be in a bit of a pickle. So let's take a look at their Q2 10K document, because I just want to take a look at this, which is really important. We looked at this when they released their earnings, but I think we should remind ourselves of this nonetheless. We can see total revenue of Let's just look at total revenue of 2227. Okay, now you can see total transactional revenue is coming in at 1.93. So you got 193 over 2227. We are looking at 86 to 87% are coming from transactional revenues. So they really need to diversify this out, and you can see Coinbase are making a real effort to drive other revenue streams from a diversification point of view. Now you can see here they've got a few green shoots, let's call them. They've introduced a few different other revenue lines, but at the moment they're tiny. I mean, you can see here it's tiny compared to what's coming through from the main transaction revenue. So you can see they got a bit of custodial free revenue. They get some blockchain reward revenue. They have their earn campaign, or they have their interest income, and they have their other subscriptions. Now we know they were served a Wells notice by the SEC for introducing their lend program. Okay, so they wanted to introduce their lend program. So that was their first attempt to introduce something else. And you can see at the same time they want to start doing derivatives. And the first derivative they want to do is Bitcoin futures. And I think this is a smart play for them, as long as Coinbase act as the good guy. And I think this is the important bit at the moment, because you can see platforms like KuCoin, OKX, you've got FTX, you've got Binance. Now, a lot of them have got the backup of the regulators, and that's why they've got a slight dull tones around their brand. You know, they're not the cleanest cut for whatever reason, just because they're seen to not get on with regulatory bodies, and therefore investors are slightly scared to invest in those platforms. If Coinbase can do everything by the book, in the realm of DeFi, staking, lending, earning, derivatives, they can really be the front runner here. They could be the gold standard of, you know, a perfectly regulated company which follows the guidelines of the SEC, and they're doing everything by the book. And I think that is something that institutions could flock to as a safe hedge, a safe investment, a safe way to get into the DeFi world and the crypto world without them having to play in the private markets on a Binance or any of these other platforms which aren't headquartered in the States. So I think Coinbase have a great advantage here and a great opportunity to really nail this on if they can diversify their income and do so in a regulatory friendly way. But the problem is, we've seen over the last week that Brian Armstrong is not happy with Gary Gensler, the chair at the SEC, and the SEC as a whole. He feels as though they're not giving enough guidelines of what is kosher and what is not, right? They want to know what can they do and what can they not do. And they need that framework so that they can get on with their business, right? So if they said, you know, in terms of the lend program, when they were sent the Wells notice, Brian Armstrong did a whole bunch of tweet storming, and he said, look, we did our best to reach out to the SEC, and they weren't forthcoming in letting us know what's right, what's wrong. So we need some clarification from that point of view, but I don't think that, you know, we need to start a war around this, okay? And I think Brian Armstrong probably did the wrong thing in hindsight in terms of going publicly after the SEC. I think he wants to keep them on side here as opposed to offside. I think if both of them can get in a room and hash these things out, I think Gary Gensler is saying very clearly in front of the Senate committee that I just want transparency, I want efficiency, and I want a competitive industry with transparency for the end retail customers and customers as a whole. And I think Brian Armstrong is trying to be on the straight path as well. He's trying to adhere to the SEC guidelines and rules. And I'm sure he wants to build a platform which is fully by the book, something which is investable asset, which institutions, pension funds, hedge funds can get into. And we saw that from their debt offering as well. They were oversubscribed on their offering, even though they had a junk bond status. We covered that in yesterday's video. And that means pension funds and hedge funds were piling in. So you can already see how Brian Armstrong is trying to position his company as the institutional friendly crypto giant, but he needs to diversify quickly away from just transactional revenue. And I think that's why you're seeing these initiatives. You saw the lend program, you saw now that they're trying to get into Bitcoin futures, and no doubt they'll be trying to get into other derivatives, including leverage, right? Which I'm a big objector to. I'm not a fan of leverage. I'll never trade in leverage, and I don't advise anybody to. It's the quickest way to get yourself wiped out. But you've got the likes of Bybit and Femex giving people 100x leverage. It's an opportunity for Coinbase to say, hang on a second, we'll come in and we'll do it in a regulated manner. We won't let people do 100x. We'll do, affordability checks and these kind of things just to make sure that people have a safe way to leverage and a safe way to trade derivatives, just like you can on the normal open market. So, an interesting yet not surprising development there by Coinbase. And don't be surprised to see if they come out with other acquisitions or other revenue enhancing services, right? They need to really start pushing on these other revenues. We saw that they did their debt offering and they increased that from 1.5 billion to 2 billion. And that will now give them the firepower to not only increase their product range of services, which bring in different types of revenue, but also allows them to go acquire companies who are already revenue generating in a different field that's not related to transactional revenue. Now, remember, transactional revenue is great, and you can tell it's 87% of their business right now. But in a bear market, what does that mean? What does that mean if because they're taking their transaction revenue based on volumes. It's not a fixed fee, right? It's based on trading volumes. So if volumes go down in a bear market, and we see that in crypto, then Coinbase will take a direct hit. Okay, so it'll be very correlated to the overall crypto market cap. Now, that is one of the reasons why Moody has kept them as a junk bond rating. For them to become a mature company, Moody gave the free requirements in their note when they deem them as a junk bond. And one of the key ones was they need to diversify their income. They need more regularity. They need more clarification on the regulation, which we spoke about. That's going to come from both of them, but more so the SEC really need to set down their gambit and say this is what we expect, and then allow companies like Coinbase to then operate against those. And then also they need to prove that after diversifying their income so that they can weather a bear market, they also need to show that they can streamline their operational costs in a bear market as well. So those are the three key things that if you're invested in Coinbase, you want to be looking out for. They need good regulatory clarity. They need to be able to diversify their income, which you can see they're making inroads into trying to do. It's clear that's always the first thing, right? To identify the issue, and you can see Brian Armstrong and the team have identified its concern. And then thirdly, we want to see how tight they can really start to bring in operational costs during a bear market. And that's something we can keep an eye on, because when revenues start to fall because volumes fall, can they streamline their OPEX so they can weather that storm and then thrive again as the market starts to tick up in the crypto space. So there you go, guys. A quick update on Coinbase heading into futures trading on Bitcoin, and no doubt the wider derivatives market, which is an absolute mammoth of an industry. You can tell that Coinbase is trying to be the de facto DeFi institution. Just how you had your JP Morgans and your Lehman Brothers and your Bear Stearns, Coinbase really do have an opportunity to be the modern, by the book, institutional player in this modern DeFi space, offering all the things that a bank does traditionally, but in the DeFi blockchain realm. Thanks for watching, guys, and we'll see you in the next one.